Hey everyone, welcome back to the Daily Gold Podcast. Today we're speaking with Greg Weldon of Weldon Financial. He's an author, a commodity trading advisor, a former floor trader himself, and he now produces advisory services for both institutions and the retail investor. Greg, as we get started, before we talk about precious metals, I kind of want to get your feel of the macro situation because I really think you're top notch and the best of the best in that category. First, I want to start off with Europe, and I just want to put forth a point. I think we might conflict here. In terms of the pig markets, I'm looking at these stock markets, and I can make a strong case based on sentiment, technicals, and valuations that the worst has already been discounted. Now, is that going to be some kind of leading indicator for the rest of the situation in Europe, or are we just going to see things kind of filter up towards the stronger countries like Germany? I mean, what's your take on what's going on now? Are we seeing kind of a temporary reprieve, and can we draw anything from the fact that maybe the pig countries have seen the worst?
Well, I would say for me, the first thing I would do is start to separate the pig countries. First of all, Greece. I think what you're saying is accurate in terms of Greece. If there was any movement, Greek markets would tend to benefit from that. Frankly, I would look at any movement towards a potential exit by Greece from the euro might be the best case scenario for their stock market, because what they would then be able to do is devalue their own currency and create, monetarily currency-based driven reflation in asset prices, and that might have an immediate and rather strong impact on stock prices that have been driven down significantly. In terms of Portugal, I think that they are not as poorly off on sovereign debt issues as they have been made out to be. I don't know that they need to be grouped into this category to begin with. From that perspective solely, they do have banking issues for sure. But their sovereign debt relative to the population and relative to some of the other dynamics are not to the degree that mandate some of the prices that we've seen, particularly in the credit default swaps. So, if you are wanting to play any kind of thought process that the worst has been discounted, Portugal, to me, is a place where the fundamentals might support that thought process. Spain and Italy, different cases. Finding reflation there, to me, is going to be difficult. I think what you said in the question is, flipping it might be more the way to watch for things playing out. And that, to me, is if Germany is softening their stance, and that is the way that they're going to go about doing this in terms of supporting Spain and Italy and France, because France is no longer a core country. France is now on the periphery, socialist-led government, softening austerity, deficits they post in just about everything every month are new lows, and continued expansion in debt. They really are grouped more in the Spain-Italy category than they are now with Germany. Okay, so that's important to note. And that leaves Germany standing alone. So if they are now going to soften, and you have the Trichet and the Chirac, ECB link out of France is gone. It's now the ECB link to Italy. Okay, everyone's going for Merkel. So if she's the next out and it's next year, and it's because she is moving to soften her stance, that would be interesting to see how that plays out. I look for Germany to suffer if they do push towards a softened currency stance away from the Bundesbank-like hard currency stance that they have stood for a long time, and the resistance has come from that to allowing a more broader, leakage in fiscal austerity and a more, debt monetized focus from the ECB. If Germany drops that focus, it will hurt their bond market, and it will likely undo some of the outperformance in their stock market. So I look at the flip side from Italy and Spain being more what happens in Germany, and what is that telling us?
So you're essentially saying that right now the German market, as far as their bonds and the stock prices there, that's really what we want to watch going forward as kind of a potential leading indicator.
Absolutely. The bond market in particular, the yield curve has steepened this week. You had big moves, some of which were unwound towards the end of the week in the European bond, in the German bond market, pretty much across the curve spectrum. But watching the 10-year in particular, the price in the futures market did break down this week, violated multi-month trend lines, and moving averages coming into play. There's a technical dynamic here now, too. So I'm watching that very closely. I'm very interested to keep an eye on the German bond market right now.
Okay, now let's move over to the U.S., or let's take a broader look, I should say, outside of Europe. I mean, to me, if you look at what we are seeing a little bit of a rebound now, but prior to that, if you look at the declines in commodity markets, emerging markets, and the strength in the bond market, it seems that these markets have priced in maybe a mild recession, but you don't see that at all at the S&P 500, which is now on the cusp of new highs. I mean, does this have any implication going forward, or is there something else that can better inform us on the medium term outlook?
Well, I think that there's a lot going on in there, and I think that the first and foremost thing is absolutely the Fed. Commodity prices came off hard when the Fed stopped buying Treasury debt. It's that simple. And especially, you can correlate times when both the ECB and the Fed are expanding their balance sheet to appreciation in asset prices, including commodities, including gold, including equities. Right now, the U.S. equity market is flying on the wings of hope that the Fed will deliver another monetary miracle here. I think that it is disconnected from the macro picture completely. I think that the macroeconomy in both the U.S. and in Europe worsened by the day. I think the statistics are very clear on this. The labor market has not been fixed. You have a chronic, long-term unemployment problem in the U.S., really almost virtually no way of unwinding that. You can't create enough jobs to take down the millions and millions of people that are now chronically unemployed and don't even count anymore in terms of the unemployment rate. All the headline statistics are really faulty, and even to the degree that headline payroll job growth, as much as it's championed by the politicians, does not even keep pace with population growth, in the labor force. So this is problematic. The housing market sideways at best. Monetary policy from the conventional side can't address this anymore. Rates are pegged pretty close to zero. With inflation falling pretty rapidly, that means real rates are actually rising. I see this as problematic from a macroeconomic perspective. And if the Fed does not deliver what is hoped for, that is a problem for stock market, particularly in the U.S.
Now, let me just follow up on that. If the Fed doesn't deliver, as you say, I mean, how much is that going to hurt, let's say, precious metals and commodities, given that up until the last couple of weeks, they've basically been underperforming equities pretty badly?
Yeah, I actually think the Fed will deliver, of course, because they have to, because they're in that position of, really last resort monetary policy dynamics. The bigger question then becomes, how aggressive are they? The timing, is up in the air with the political situation in the U.S. It's a big election because the fiscal future of this country is really riding on this. That's important to the Fed's decisions. Right now, actually, U.S. the Treasury fiscal policy is working against the Fed because you have an increase of $200 billion in public borrowing needs this year alone. So that's $200 billion that the Fed pumped in that's not there anymore. So it's interesting to note that, of course, as well. The question then becomes how much? What are they going to do, and by what degree? And this is where I sense there could be disappointment. I could see, riding the wings of hope here. You get some last blast push when and if the Fed acts. If it were in concert with the ECB, maybe you get a little more bang for your buck. The problem is one of mathematics. If you want to be consistent with the numbers that surround the increases in the Treasury purchases and their underlying holdings in QE1 and QE2, QE3 would have to be over $1.2 trillion in size. If you are looking at the ECB and you are looking at their experience in 2008 during the crisis, and then in 2011 with their bond buying started in August, the LTRO in the fourth quarter, and then the early part of this year, their second LTRO, the peak 3-month expansion and balance sheet was 600 billion euro, both times, 2008 and 2011, very consistent. I struggle when I look at these numbers, and I think that that's what the size of the packages could be. So from that perspective, I think there is the potential for a setup for disappointment where the market rides this rally hope, kind of gets the package, celebrates, and then turns around and goes, we're not so crazy about this. So it'll be interesting to see how that plays out.
Now, I just want to follow up with the things that central banks have to do in the next several years. Bloomberg, there was a guest on Bloomberg who reported that as far as the U.S., we need to essentially roll over 59% of our debt in the next 3 years. And I know that there's a similar situation for Japan and a lot of the other countries. I mean, in the next 1, 2, 3 years, I mean, aren't central banks going to have to ramp up their efforts anyway, just to just because nobody else is going to buy all these bonds?
It's a great question. It's a perfect, much unasked question. We actually addressed this in one of our Money Monitor research publications, which anyone that is reading or listening to this is more than welcome to come get a free trial through our research on our website. We just addressed this exact thing in the U.S. because in the U.S., and this was true as of 8 or 9 days ago, so I can't speak if the numbers are exactly true right now, but I'm pretty confident they are. At any rate, it is what it is. And the bottom line fact is, between now and the end of this year, you have more Treasury debt maturing than you do all of next year. Okay? Last count, it was $1.897 trillion in the next, 4.5 months. That's a lot. $97 billion in interest payments, and then you have another probably $400 to $500 billion in new public borrowing just for the deficits they're running right now in 2012 on the Treasury administration side. That is that is $2.5 trillion due in the next 5.5 months. If the Fed is not in play, that is problematic. From the bond market perspective, you will see higher yields in the U.S., higher interest rates in the U.S. at a time when the labor market and housing market are not healthy enough to deal with that. So it's almost imperative that the Fed comes into play. The problem is one of timing around the election. Does it give them enough time? Can they act before the election without being seen as political? I don't know. I don't know the answers to that question. I think they'll pull the trigger if they have to, and they're going to have to. I don't think it's even in doubt. And you also mentioned Japan, by the way. Huge refunding needs in the next 18 months. Just enormous. Not talked about a lot. Huge because they're a net creditor nation. If you start to see, it's another great thing to watch is the Japanese bond market. You see a crack in that bond market, man, you want to run for the hills because that is going to be a big event. It will mean it's a big sucking sound in terms of liquidity. You can repatriate it back into Japan for them to, refund this debt, and it would be something that I would say is one of those landmine risks that lays out there that if the market steps on it, it's gonna lose a leg.
Before we get to bonds and more specifically precious metals, just a very quick follow-up question to what you just said. The fact that in the U.S. and globally, there's going to have to be ramped up monetization efforts in the next several years. Is that the biggest catalyst that kind of propels precious metals into kind of closer to a bubble?
Yes and no, and I think that clearly in the U.S., the average maturity of our debt is in the 5-year range. So what you said before is quite accurate and pertinent. That you have this near-term dynamic that is largely being ignored while all the talk is about the long-term dynamic. Now, that talk about the long-term dynamic politically is awesome. I mean, it needs to be discussed and put on the table. But what is not being discussed is the near-term dynamic. The current deficit, $309 billion in spending in July by the Obama administration. This is the 10th highest month of spending. They're allegedly kind of rolling back some of the spending. And where were the largest increases? Social Security, Medicare, all the places at by the way, record highs in terms of monthly spending by the government on these programs. Only going to go higher. So, yeah, you have a long-term problem. You have the short-term problem. No one talks about the short-term problem. The Fed is not going to have to be in play in QE3. The Fed's going to have to be in play in QE4 and 5 and so on and so forth. This is a cycle that's not going to end anytime soon. And when you look at Europe in this dynamic, very interesting to me to note, countries like Italy, who have debt that's coming down the pike, was certainly true a couple of weeks ago, less so acutely now, but still the case, where they have long-term debt maturing. They didn't want to pay out in the 6% range to borrow money, so they rolled the stuff over for like 187 days. So now they are facing a huge short-term debt refunding obligation that they didn't have before, that is in addition to their current sovereign debt schedule. So, Italy, too, kind of playing games with their maturities that is not necessarily in their best interest.
Okay, now let's get to the U.S. bond market, because the last, they did the first QEs, the market kind of really surged in anticipation of that, and I guess it was acceptable for them to do the QEs because the bond, the bond market was so high, and of course they know that rates are going to go up after they do it. But would they still? I mean, in other words, could the bond market and this financing, the deficit situation, and these funding needs, could that force them into doing more monetization? I mean, regardless of if they're unhappy with where the bond market may be at that time.
Unhappy meaning why? Because rates are higher.
Right. If yields are higher.
Well, yeah, more so if rates are higher, of course, because the economy can't handle it, and the mandate is to try and stimulate full employment, and they're so far from that, it's not even funny. So, I mean, they have the rationalization to do just about anything they want. I wouldn't want their job for sure. It's really, really tough. The question again comes down to how much are they willing to do. It really does. Are they willing to do 1.2 trillion? Because that is, that would be consistent mathematically. It would be relative to the amount of debt maturing consistent. Is it politically feasible? I mean, can they pull the trigger on that? Will they get support from the country? Will they get support from internationally? I mean, there's a lot of question marks surrounding the Fed, but I absolutely believe that they will be forced by the dynamics surrounding all these deficits to act. There's no doubt. They would love to see fiscal austerity as the complement to that. We see that in Bernanke's, testimony on Capitol Hill. So far we're not getting this at all. So that's something that's lacking in terms of, the Fed. But the Fed will do what they have to do. If they're standing on, the precipice and staring into the abyss of a debt deflation that comes about by a spiral up in interest rates caused by too much Treasury supply, they will absolutely act, every day of the week because they feel they can deal with the subsequent reflationary dynamics more than they can at debt deflation. And that goes back to the other point, too, that I want to make in terms of your question. What we're learning here is because, you can't address the housing market, you can't address labor. The only thing they have any bang for the buck in terms of generating any kind of sense of well-being, feel-good factor, reflation, any kind of wealth reflation at all is in the asset markets. So, to the degree that the Fed has been focused upon this has also become, very interesting to the degree that we might see this now in precious metals as well.
Okay, well, that's a great segue so we can get into precious metals. Let's start with silver because I know you had some insights there. So why don't you tell us what you're seeing?
Yeah, one of the things, we are saying that we're looking at silver more favorably here for the first time in quite a long time, silver and gold. In silver, the situation that is point of interest is the decline in the warehouse inventories. The exchange warehouse inventories down significantly. The swings in them, and we look at a 6-month moving average as well, are very highly correlated to swings in price, and this goes back, over some time during this bull market. The recent low at 2607, which is a triple low, by the way, right in the zone of the 50% Fibonacci retracement of the entire bull movement silver from 2001, was set the same week that we saw the peak in inventories. And silver inventories went through the roof during this price decline. So that's one thing. They have come off hard. They have come off below the 6-month moving average. 6-month moving average is turning down. The peak in inventories was the same week as the bottom in prices, and you're getting an improving technical picture. And the 1-month implied at-the-money option volatility is the lowest it's been since 2007. So this is a pretty interesting little confluence of things that suggests there's an opportunity here in silver for a technical breakout. We're looking at a couple levels, 28.33 is one, and then 28.90 in the futures contract is the second one. Above that, you got about $7 or $8 of upside TSC resistance in gold. Similar picture centered around the 1640 level in the December gold. Not a heck of a lot of resistance to get to 1800 in gold. So, it could be a pretty interesting move. Coming on the back of now hope for Fed action actually becomes action. You get a big rally, and then you get up to these levels of 1800 maybe in gold and 3750 in silver, and then you look at the size of the packages that they've done. You know they got to do more. You know the dynamics around the Treasury. It's not all positive. Then we got to reassess it if and when we see this take place.
As far as the COT for gold, I think open interest has been declining pretty steadily. Can we infer anything from that?
It has, and nor have we seen any pickup there. There's been some, some headlines made by some of the bigger investors who have plunged back into the ETFs and gold. I mean, even the ETFs, their holdings of physical gold are sideways. It's really been sideways since June of 2010. In the cumulative traders report, it has been a fairly substantial decline, very much in line with the price decline in gold. In the net long position by large speculators, so that's something we're watching. Again, not yet seeing a pickup there, but it's going to take a technical breakout, and you will see that, and that will potentially provide you, the firepower to drive gold, higher. I mean, this is really kind of the setup here. Maybe it doesn't even take as big a Fed package as we might think it will to generate at least this initial wave of rally in the metals, because you have speculators on the sidelines, and they could come in pretty quickly to get a technical breakout. They'd be more than willing to play that, and if the Fed were to deliver anything, even if there was disappointment to follow, just the mere fact they delivered could create enough of a frenzy, to draw those speculators back in and drive prices higher, and that's pretty much what we might anticipate seeing here.
Right, and I'll just throw a few things out there on top of that. Going back to silver, I think nominally speaking, the speculative long position was at a 10 or 11-year low at some point in the last month or so. And also, if you look at the action in the shares, both the gold and silver shares, I mean, they really seem to be telegraphing that we're going to get this push higher in the metals. Would you agree with that?
I do. Clearly, the mining shares have underperformed. They've gotten crushed. Some of them have even taken out the 2008 lows. Even some of we look at the silver mining shares as well. They do have some interesting little technical patterns here. There has been some signs of exhaustion to the downside. Closely watching the HUI S&P ratio on that. But some of the technical patterns don't look so bad. Some of the bigger cap mining shares, we also do some technical quantitative work on the metals and the mining shares and the ETFs. It's in our Metal Monitor publication that we do, and there has been improvement. The improvement in the sense that the bearish trend has become significantly less dominant. So that's a positive. We're not running out ready to buy these metal shares. There are a couple of the really junior mining shares on the silver side that we do like. There are a couple of low price, kind of venture cap, risky type of sitting on physical metal, not even really mining it type of names that we feel are interesting in the next round. If you do get Fed pumping money, the economy doesn't need it, where could that go? I noted there was an interesting little story on Kinross today, raising some money with a bond sale and so on and so forth. Maybe there's some merger and acquisition dynamic to be had here. Some of these real low priced mining shares, the venture capital type mining shares, are sitting on big properties. And I mean, if this is the next wave of looking at these metals and looking at places where you have metal in the ground where it's you could mine it if you wanted to pretty cheaply, that may rise in value. So that's something that's a kind of a wild card dynamic that we talk about sometimes that could provide some opportunities.
Okay, Greg. Well, before we close, why don't you tell our listeners how they can check out your work? I know you offer a free trial.
We do. It's a 30-day free trial to any of our products. We do the Money Monitor. It's our top-down global macro piece. It's really our flagship product. The Metal Monitor is an audio product once a week that I talk about the markets with an overlay of charts where we have a pointer, and it's a lot of people like that. The ETF Playbook we're also still publishing, although we're thinking of discontinuing that. It's equity focused. And really the one thing we're excited about right now is our new metals-only program. We operate as a commodity trading advisor under the NFA Series 3 license here in the U.S. And our new metals-only program, it's a smaller minimum account size than what we have dealt with our institutional account. It's $150,000 minimum. It trades the metals only. The 20-year back-tested track record, if you will, it's quantitative in nature, is pretty good. We're pretty excited about this. The 3 and 5 and 20-year returns are all very solid. And I think the opportunities in terms of taking advantage of this volatility, because it's the potential to be long and short these markets right now, on the knowledge that there is much more volatility waiting out there for us because there is so much uncertainty. We have talked about it all. You have laid it out with great questions here in terms of, looking at really what we are facing, and it is a tsunami of problems. And they will try and deal with it, and that will create big up moves and big down moves. There is much more volatility coming down the pike, and we have designed this program. I have designed this program quantitatively, specifically, to take advantage of that. So we're pretty excited about that as well.
Okay, Greg. Well, thanks so much for your time today. I really appreciate it. It's my pleasure to have you on, and all the best to you, and I look forward to chatting again the next couple of weeks.
You got it, Jordan. Thanks so much for the invite.